So today I want to talk about the top 5 mistakes I always see investors make. Every time I talk to an investor and I talk to them about investing, I always notice some of these mistakes always popping up. And of course, there's one thing to make a mistake because mistakes happen. Mistakes will always happen. But the most important thing is to learn from your mistakes. Never let your mistakes get you down. Always look at it as a learning experience. So, with that being said, let's look at these 5 mistakes. And at the end, I might even throw a bonus. I might even do 6 mistakes. So, let's get started. So, the number one mistake is following a stock market guru or listening to a stock market guru. Now, this is a mistake that will happen to pretty much everybody because that's how you kind of get introduced to investing anyway. Well, many of us. So you might be online, you might be reading a book, you might be going to a seminar on investing, and there's always somebody who tries to pitch you some type of deal like buy these specific stocks or follow me on social media and I'll tell you what to buy and sell. Now, when it comes to stock market gurus, and even when I'm on YouTube and I'm just browsing through YouTube and looking at different videos on investing, there's always an advertising that shows one of these gurus telling you that they found a perfect system that made them a lot of money and they want to sell you this system. So, one thing you have to keep in mind when it comes to stock investing gurus is that most of the time they get paid or they get a kickback from whatever they are promoting, whatever they're advertising. So, if a stock market guru is always talking about a specific mutual fund and how well it has done in the past and what the returns look like, and they're like, okay, you got to buy this, buy it, hold on to it. Most of the time, they get a kickback from that company that created that mutual fund. Now, besides the stock investing guru, you should also avoid following the crowd, following the herd. So especially if you're a investor that just started investing, or even if you're a experienced investor, there will always be people that come your way or come in your zone and they will tell you, okay, buy this specific stock. This stock is hot. You should buy it now. Just buy it. And that's something that I even come across on a frequent basis. I remember one time I was shopping in Walmart and I was shopping at Walmart in my local neighborhood at night, and there were 2 guys that came up to me and they told me you should buy the Walmart stock. And they did not give me any more explanation. They just said, okay, you should buy the Walmart stock. Walmart, like, just buy it because we were in Walmart, right? So this is also about the time when I started learning how to analyze individual companies, doing fundamental analysis. And one thing that I always pay attention to before I buy a company is to look at the PE ratio, which is the price you are willing to pay for the earnings of the company. And at that time, the PE ratio wasn't looking too great for the Walmart stock. I do own stock in Walmart, but I like to look at a PE ratio of at least 20 or less, and 15 or less is even better. And at that time, when that guy told me to buy Walmart, the PE ratio of Walmart was over 30. So definitely, I'm not going to buy it. The 2 guys I met at Walmart that night that told me to buy stock in Walmart, those 2 guys were strangers, of course. But what usually happens is that you might meet a family member or a friend who's going to tell you to buy a hot stock, whatever stock is hot at that moment. So, for example, let's say Facebook is in the news constantly. They're going to tell you buy Facebook stock. Or let's say they read an article or they watched a video or they even watched the news and they saw Tesla constantly being talked about. They're going to tell you buy stock in Tesla. And this is pretty much just speculation. They're pretty much going to tell you buy stock in Tesla because I can see the price going up in Tesla. Which also reminds me that I have an uncle who is a Tesla diehard fan. Every time I talk to him about the stock market, he tells me that he should have bought stock in Tesla back when it was trading at around $6. Now, of course, it's a lot more expensive. And whenever he tells me that, I constantly think about the fundamentals of Tesla, and I'm like, I don't want to buy Tesla right now. Maybe in the future, but right now, no. Number two, not being patient and expecting wealth immediately. Investing is a long term process. If you look at the wealthiest investors that we know of, such as Warren Buffett, Charlie Munger, Ray Dalio, these are guys that have been investing for decades and they've built their wealth over those decades. Most people think about getting rich fast in the stock market. Is it possible? Yes, you have those stories where somebody took 10K and they turned it into $1 million. Most likely, that's not going to happen. Also, keep in mind that if there's a potential to make money fast, there is a greater risk. There's a extremely high risk to lose your money. So yes, you can make a lot of money fast, but you can also lose all your money pretty much real fast also, even faster. Number three, not enjoying the investing process, not appreciating the investing journey. So you don't have to be passionate about investing. You can be a passive investor, but you do need to have a specific or certain level of interest in investing. There's so much to learn when it comes to investing. And if you're the type of person that, okay, I just want to make a quick buck, that's not the way to approach it. Think about it like this: you are going to make mistakes when you invest. And if you're the type of person who's not really interested in investing, after a mistake or two, you're going to be like, okay, I'm done. I don't want to do this anymore. You might do day trading for a day or two, and then you're like, okay, this doesn't work. Then you might try something else, and I'm like, okay, this doesn't work. But if you are interested in investing, even though you're making mistakes, you will try to learn from your mistakes. And even if it's a specific technique that doesn't work for you, you'll try another technique, but you'll go in with some interest. And there's absolutely nothing wrong with being a passive investor. So, an investor who might invest in mutual funds, index funds, or ETFs compared to a day trader. A day trader being somebody who's always buying and selling, always constantly having to pay attention to what the market is doing and analyzing different charts. So, number four, I kind of hinted on number four already, giving up too early when it comes to the stock market. So, everybody has a bad experience with the stock market, or everybody knows somebody who has a story on a bad experience that they had with the stock market. Even when I think about it, my dad back in 2005, he lost a ton of money in the stock market. Pretty much what happened, he got a phone call from a company that tried to sell him shares in a couple of different companies. And they were able to pretty much sell him the dream. And he bought those stocks. And after about a year or two, when he logged into his brokerage account, boom, he lost a ton of money. Even when I first started investing, I never thought about just quitting or just giving up, even though everything seems so confusing. For example, what's the difference between a 401k, a Roth IRA, and an IRA? I had to do the research and pretty much step by step, day by day, I tried to push myself to learn more. And once, as a passive investor, I'm like, okay, I pretty much got a good handle of this. Let me see what's next. And that's when I started teaching myself about fundamental analysis, how to pick and choose individual companies, which was, of course, a learning curve, learning about the PE ratios, the return on equity, looking at debt, income statements, balance sheets. So definitely never give up at the beginning because it does become easier. And of course, everybody goes through a learning phase. So just stick with it and it will become easier. Number five, not having any goals when it comes to investing. Most people, when they just start out investing, they just want to jump in the market, put some money in, and see how fast they can make some money. So they might think about putting in $100 or $500, and let's see how fast I can double, triple, or quadruple my income. That's not the way you want to invest in the stock market. You always want to have a specific goal. Even if your goal is to make money as fast as possible, yes, write it down. So you might be a short-term investor, so you want to make money fast, write down your goal. Or if you're like me, you're more of a long-term investor, write down your goal, write down what you want to accomplish, how much money you want to make from the stock market. And once you have your goals written, that's when you can look into different investment opportunities, which will make it able for you to achieve that goal. So, for example, if you think you're the type of person who can take on a lot of risk and you want to make money fast, or you think you can make money fast, try being a day trader. Write it down. Write down how much money you want to make every single day and see if you can achieve those goals. But if you want to do a long term investment strategy, write down that specific goal also. What should your investment account look like? Look at asset allocation. Look at, okay, how much do I want to have money wise in my investment account? Do you want to build it up to 100,000? Do you want to build it up to a million? Write down those goals, which will give you something to focus on. Now, goals aren't set it and forget it. If you look at your goal and you're like, I'm not going to be able to achieve this in a specific amount of time, you can always change your goals. And for the bonus, always educate yourself when it comes to investing. You don't want to be like my dad who got scammed and lost a ton of money because he did not know what he was investing in. Nowadays, there's so much information, and you have to be careful with information overload, of course. But there's so much information out there. You can always do some research on, even if it's a specific mutual fund or a stock that somebody's talking about. You can jump on the internet, look at the ticker symbol, and do some research to see if it's a good stock or not. You do not want to rely on other people's opinions. Always do the research first. Always educate yourself. So I hope you like these five with a bonus one mistakes that I talked about. Let me know in the comment section and I'll talk to you guys in the next one.